And looking at that local currency, it seems that we are starting to see a bit of strength. Do you think that it actually can be maintained at these levels, given the fact that we also see an interest rate environment that is actually supporting a much stronger local currency?
Yeah, I mean, you're right. If you look at probably the reason for the strength that we've seen over the last 2 or 3 weeks, part of that has been the carry trade, the return of the carry trade. And we've seen offshore investors, buying Kenya shillings and putting their money into high-yielding treasury bills, so they could profit from that sort of return. I think the key things you look at going forward is, number one, the risk environment. In the event that we actually see, based on pressures in the Eurozone and elsewhere, we actually see, a risk-off environment, risk aversion will probably lead to the carry trade not being as viable on a risk-adjusted basis. At the same time, we're also been seeing interest rates because of their currently high elevated levels. We're seeing the marginal propensity to import has actually risen. So importers have been out of the market, so that has taken off some of the demand of the dollars, while at the same time we're seeing increased cash flows from horticulture and other and remittances as well. So that's helped to support the shilling. So as far as the interest rates are concerned, probably going forward, we'll talk about maybe the second half. As we start seeing that having downward pressure on the Kenya shilling.
And Evans, I mean, as you mentioned, the point is that we've got less dollar demand that is coming through. And the point is the exporters must actually be feeling the pinch right now with regard to a much stronger shilling. What are the exporters doing right now to ensure that they do benefit from any sort of weakness that comes through in the shilling?
I think those who are ahead of the curve probably try to hedge at, probably much more favorable rates than we're seeing in the market right now. But a lot of these probably wanted to ride the exposure because they believe probably coming into the new year that the Kenya shilling was again going to weaken to levels we saw. So a lot of exporters probably wanted to have exposure to that. But we're also seeing some more hedging activity being done over the last 2 weeks.
Evans, what is the likelihood that we could see the shilling hitting 107 to the US dollar level, a record low that we saw hit it in October last year? Do you think that that is a possibility once again? Are exporters anticipating such a move?
Well, I'd say, as I'd mentioned earlier, I think around December, coming into January, I think there was a lot of that, sentiment in the market, with a lot of exporters thinking things would go back to normal, and a lot of the currency strength around that time was actually attributed to the fact that exporters were out of the market because that was, low season going into December. But actually, from this point onwards, if we look at the fundamentals alone, the kind of probably portfolio flows that we're seeing into the market right now. At the same time, we have that $600 million loan that's probably going to be closed in a week or two time. We have World Bank upping their foreign direct investment, and all these factors are positive for the Kenya shilling. Now, as far as deteriorating back to 107, I certainly see the risk of that is probably minimal. I'd say technically, if you want to look at the charts, you probably look at the US dollar Japanese yen chart around the 1990s when the carry trade collapsed. So what happened then on is probably the yen strengthened, and then weakening from there on probably did not hit levels that were seen previously. So 107 probably not going to see it this year, certainly if we are going to see it at all.
Okay, so you're talking about foreign appetite for Kenyan debt. We also know that an infrastructure bond is going to be launched, 12-year bond, very attractive from a yield perspective. And it seems that the central bank is targeting a lot of the diaspora to ensure that they do have the right appetite, the appetite that we've seen over the past few months for Kenyan debt. Can the market expect similar movement as we've seen over the last couple of months?
Okay, as far as targeting the diaspora is concerned, I think if you look at probably what happened during the last probably sort of sale that they had targeting the diaspora, that wasn't well received by that particular segment, and the reason was probably because the marketing wasn't up to speed. I mean, they started marketing the issue probably about the same time that they opened, and they did not really extend, so we did not really see that happening. Now, as far as the yield being attractive, yes, certainly investors will be looking to lock in at current yields. But if you look at the reopening of the 12-year bond, I mean, the maturity period left on that is probably about 11.64 years. So I think a lot of players who are probably looking to lock in high yields will probably want to avoid that particular because it's farther along the yield curve, and the expectation that the central bank will be offering probably longer dated bonds than the 1-year bond that they're doing right now, probably about 5 years. So that would certainly be seen more attractive. I wouldn't be surprised if a lot of market players probably try and avoid this auction and anticipate future auctions along more variable points of the yield curve.
Evans, you're talking about very high yields. Can we anticipate a yield very close to 17%?
At 17% for the 12-year?
Yes,
I
indeed.
think that would be probably within market expectations. I think that mentioned about 16.46% is where they're going to issue it at, so 17% seems fair enough. But based on the direction we see interest rates taking over the next 6 to 8 months, you might actually see some players, probably insurance and pension funds, looking to lock in. But I think commercial banks probably want to, probably about 60-70% participation from their probably normal levels for this particular bond.
Evans, are you going to be involved in bond purchasing? Do you find it attractive at this point?
Yeah, at current yields, I mean, we launched our strategy note probably around just sometime last month, probably this 4th week. And what we were saying really is that within a 3-month outlook, we're overweight on cash, we're overweight on bonds. Within a 12-month outlook, we're still overweight on bonds because, we expect yield compression starts kicking in probably within towards the end of second quarter going on. So really, the bond space is really attractive right now.
Yeah. Evans, do you enter the bond market and hope to be a trader within the market, or do you actually hold on until maturity?
I think for most of our clients, we kind of have different portfolio strategies. There are those who would probably want to lock in the high yields because, based on the most recent auctions that we've had, I mean, we've had the coupons at about 20%, 20.1%. I mean, that's fairly attractive. The players would want to buy and hold. But certainly, wanting to trade with the commercial banks because, earlier in 2011, what we saw is that most of them shifted the bonds, from their available for sale and held for trading books and moved them into held to maturity. So a lot of those are going to miss most of their upside when yields start coming down for their other income line item in their probably their income statement. So some of those you might see coming back into the market, so I'd probably want to see a trader trying to pick it up, but probably hold it up until such a time as yields go down and benefit from the capital gain.